several people sending emails, they couldn't make it tonight because of their vacation schedule. Bea is kind enough, she's gonna take today's class, for folks who can't make it. Let's see next class how many people, because if we could, we probably would be a good idea if we sort of occupied the first 3 rows instead of 4. Just because there may be 2 or 3 more people coming tonight. And I'm always curious what brings people, what their backgrounds are, where they work, where they live, and sort of things like that. Why don't we introduce ourselves? If you don't mind, I'll go last. Valerie, mind if you get the honors? Sort of, again, where you work, what your experience, if any, you have in the income taxation of trusts and estates.
Hi everyone, my name is Valerie, and I work here in Ruckus as a certificate bookkeeper, and I don't really have any experience in income tax trust and estate, but I just have a little bit of experience in tax itself, because I like to prepare my own taxes out of people, so that's.
All right, so your background is limited, that's okay. Alicia?
I work for a small public firm, and I did like simple trust, estates, that's it. Nothing big, nothing complicated.
Simple 1041s. Bea?
Yes.
I go by V. No experience whatsoever in trust and estates.
All right, so this is new territory,
Yeah.
completely. Carlo?
Carlos Samuels, I work at Goldman Sachs. I have no experience in trust and estate either. Do my own taxes, no experience in tax, but I just changed my tax reporting this month. So.
All right, so we're going to be immersed. Shane?
Hi everyone, my name is Shane. Again, I have no experience in income trust and estate. I'm currently not working.
Okay, we're going to make it more employable. Dane?
Hi, my name is Dane. I don't have any experience in trust or estate tax. I interned with PwC last summer in ISG, their industry services group, and I'll be starting with them next summer. Right now I'm just a full-time student and studying with the CPA.
Okay. Harsh?
Hi, I'm Harsh. No experience with trust and estate taxation. I'm self-employed.
So you have very limited experience.
Well, I studied for CPA exam, but after that.
I studied for the CPA exam. Buddy?
Hi, my name is Katie. I work for a public accounting firm in New Jersey. I have very limited experience in trust and estates, but that's about it.
Okay. Julia?
Hi, my name is Julia Bernal, and I have
No experience.
trust me tax. I work in New York, but it's okay, right?
Okay. Javier?
I'm Javier. I have little experience with trust, and I work at Conde Nast, preparing trust and estates.
Well, where do you work?
Conde Nast?
Where is that?
In New York City.
Okay. Gotcha. Jessica?
Hi, Jessica. I have limited experience in both, like, I guess, the simple time trust for individuals, and then I did some liquidating trust for businesses.
Okay.
I'm not currently working, but I'm currently interviewing one day or
Well, you're currently, say that again?
I'm gonna be interviewing
Oh, you're interviewing.
on Tuesday, so.
Okay, good luck.
so,
John?
I'm John Fiore. I work for Weekly Financial Group. Don't really have any tax experience with trust and estates, but I open and maintain accounts for them fairly frequently, so I get some background knowledge on that tax case.
Good?
My name is John. I work for a accounting firm on Staten Island. We prepare estates and trusts, but I've never actually done.
Haven't done it.
No, I have not done any.
All right. Simone?
So my first name is actually Shaniqua, but I didn't want to challenge you with pronouncing it.
Yeah, that would be tough.
Yeah.
Shaniqua.
So last name Simon, so you can call me.
Can I try Shaniqua? Can I try?
You can try. Good luck.
Is it Shaniqua? 3 syllables.
Yeah.
Maybe if you put it phonetically, I'll make it happen.
Very limited experience with trust and estates. I work for a private real estate firm.
Okay. So very limited experience. Edward? okay? Your timing is impeccable. We're just trying to, by the way, does anyone get the distance award here in terms of where you live, where you think you vie for the furthest place away from Newark, New Jersey? Anyone from, I mean, someone's got to get the distance award. There must be one person. Who travels far to get here? Where do you come from, John?
Staten Island.
Wow, Staten Island. Okay, that's not around the corner. Anyone else think they can beat that longer distance?
Oak Ridge.
Edwin?
Oak Ridge.
Oak Ridge. Now, how does one get there?
It's basically starting at New Brunswick campus. You're heading across Route 18, and then.
So is it a good hour and 15 minutes from here?
Yeah, pretty much.
Okay. Anyone beat the hour and 15-minute mark? No? All right. That's not bad. Sometimes I get people from southern New Jersey, and I'm like, wow, you guys dance on the ceilings to make it really worth their while. But you guys, I'll still try to dance. I'm not very good at this. But I'm going to try out 2 new drinks, Amazon Energy and High Brew Double Espresso. So watch out.
That's good stuff.
Good stuff, is it? And Monday's Nitro from Starbucks. So we're going to power up down here. Type of thing. So particularly on a hot day like today. So by way of quick background about myself, I've been teaching Rutgers now. It gets kind of scary for those who have me Monday night over 20 years. And when I'm not teaching, I practice up in the Morristown area, and I do a lot of tax and estate planning up there, and I do a lot of trust and estates work. And throughout the semester, I am going to be looking hard at our textbook. Everyone, good news is, as opposed to the income tax course where everyone had to get the 19th edition at $200 and some odd dollars. Many of you have gotten a used edition of our textbook, right? And how much did many of you pay? $20? Something like that. You rented it? So that's the good news for your team. I am in the midst, and we're coming, I think, closer. I'll see if this really works, where I am putting together, with the help of 3 other people, a new textbook in this area. And it's on my computer. All 8 chapters with the introduction and conclusion are written. I hope to be submitting this soon to the editor. So we will see as the semester unfolds. I may test you guys out in terms of there's a few chapters in this book that I think are worthless, but that we're going to switch it out, okay? So just to give you an idea, I'm going to try to have, like I said, 2 years from now. I was hoping to have the textbook ready for this semester, but when you work with co-authors, it's like a Cracker Jack box. You're never quite sure what you're going to get. And I got some good, and I'll leave it at that because I'm being taped. I shouldn't say who knows where this stuff goes. So it's been a little bit more of a challenge than I anticipated, but I think we're getting there. Insofar as this textbook is concerned, guys, Mark Asher wrote the original. You will periodically see cross-references to a famous treatise called Scots on Trust. It's the ultimate treatise on what the law on trust, okay? If you Google Scots on Trust, that's the go-to source. Mark, Mr. Scott lived, he was a Harvard professor. He lived about 100 years ago. And every 20 or 30 years, there's a new person who takes over to update the treatise. Mark is that guy, okay? He's at University of Texas. I am friends with Mark, I'm not BFF. We see each other occasionally, I'm in touch with him once in a while. Very nice guy, very erudite. Gotta look up, he's in the stratosphere of the world in terms of academic stature. Bob Danforth, more of one of my contemporaries. Very nice guy. I've seen him more often. He came in on the second or third edition. But I know, because I don't want to step on toes, so I asked Bob, I said, listen, I'd be happy to work with you to come up with a new addition to your book and take this to the next level. And he said, listen, Mark is pretty set in his ways. He doesn't really want to do a new edition. So I said, if you want a new edition, don't feel, or a new book, don't feel like you're going to step on our toes. So I'm just letting you know, I'm not trying to ruffle anyone's feathers here. But be that as it may, you might say, gee, this is a 2008 book. There are not that many textbooks. In fact, this is the only one in the entire country on this area of the law. It is a good book. It is not the best book, but trying to write my own textbook, I can see why there is no perfect textbook, okay? So bear that in mind. I've used it for many, many years, and students, generally, I try to highlight the salient points, and it seems to have worked well. There is a brand new, sorry to break your budget, but there's a new, like, short version of our book that highlights the salient parts. You probably won't find a used edition because this is hot off the press, but this is now $200. I think they charge $20, $25. During the break, if anyone wants to take a look at this, federal income taxation of trust estates and beneficiaries. All right? Written by a guy who I know, and very nice guy, Grayson McCouch. He teaches at University of Florida. So as the semester unfolds, you may consider getting this book just because it's obviously a lot easier to perhaps look at than our textbook, and like fill in some gaps where you want a secondary source. So everyone see this book? Again, it's not a sine qua non that you get it, but can probably hurt. But be forewarned, it's not going to be expensive, but it's not going to be cheap either. All right? Logistically, guys, most of you have had me before, but if you haven't, we have traditional midterm exam worth approximately 45% of your grade, final, more heavily weighted, combination, true, false, multiple choice, short answer kind of questions. Really stuff we've covered in the class. Don't look for extraneous material. And by the time you're done with this course, my objective is to make you really know the landscape of how trusts and estates are taxed and make you comfortable when this comes up in your practice. All right? So at least that's my objective. Any questions, logistic or otherwise? Everyone got parking tonight. Unfortunately, the cafeteria downstairs is closed. I don't know, they're doing remodeling. It's not clear to me if that's going to open until January, because I think they're putting a Starbucks there. So that's the good news and bad news, as I was saying to my income tax class. I did bring in some snacks for our break because fearful that there wasn't much out there. So you guys will be, there'll be some sustenance, but it's not highbrow stuff. All right. Any questions, material-wise or otherwise?
Yeah, so what is exactly, because I'm Googling it and it doesn't show up, Scots on Trust?
Scots on Trust. That didn't come up? Number one thing?
So,
Scots on Trust did not come up?
like the Ross people, Scots?
It's put Scots on Trust treatise. Scots on Trust treatise. Karen, come on down. You find us, Karen? You look,
No, I was going up. Oh, I just thought there wasn't really any traffic there here. It was on vacation. Wasn't the case.
Karen is our stargazer. Karen is a can I say, astronomer?
Yeah.
Right, so when she's not studying facts, her mind is in the stars.
Did you see UFO already?
I don't know if she saw any UFOs. All right. Anything else? No, you didn't see it, Alicia. You put Scots on Trust treatise.
What about in Scotland here?
Is this the laws of trust by Austin Bateman Scott?
Yeah, it's a treatise. It's a multi-volume treatise. If you guys had the energy, I'd take you on a field trip to the law school about 6 blocks from here, and we'd look at it. It has like 8 volumes, all right? That goes far into depth, and again, Mark Asher keeps it current. He's like the keeper of the treatise for now, till someone of his stature takes over. All right, but you're not going to be, I'm going to be highlighting how trusts function as a legal entity, but fear not, guys, you're being tested on the tax aspects, not the legal aspects. So you don't have to worry about getting too much into the mud about that aspect. I'll have during the break, you'll see there's a handout here. All right, so everyone got, I hope you did, that I asked people to read the first 45 or so pages of the textbook? Yes? I hope. And even if I didn't, I think most of you know, or have had enough classes with me to know that I usually don't have the first class as a meet and greet. Got to make your tuition dollars go far, right? So do bear in mind, notwithstanding that this is a 2008 edition of the book. If you go on the website for this book, there is a 2018 supplement that brings up to date. And what you'll notice about the 2018 supplement, and if you have a problem finding it, let me know. I can help you. The law pertaining to subchapter J, the Internal Revenue Code, has largely stayed the same for the last 20, 30 years. I mean, there's been some changes, but not momentous changes. So you might be scratching your chin and say, gee, we're using an out-of-date book and it should be updated. Even the 28 supplement to this material, guys, is not very long. There's not been many changes in this area. Yes, under Code Section 1, the tax rates have changed. But we know. Does that mean much in our existence? It means the computer is going to put in a different tax rate and plop out a different number. But for practical purposes, it really doesn't mean much. So don't worry that this is a 2008 edition. All right? Is everyone here today have the book? By the way, Carlo, you have enough pencils for the whole class. Is there a reason? All right. I just figured you might want to share for the classes to give in that opportunity. All right, so if anyone needs a pencil or pen, you know Carlo is your go-to guy. Again, I don't want to, logistically, I left out 1 or 2 points, but if you need me, send me an email. Try to get back to people very quickly. Make sure in the subject line that you put student in your income taxation of your trusted estates class, okay? So just make sure you flag it so that I get back to you. If I don't get back to you, usually that day, don't be bashful, send it again, put high importance. I also regularly 2, 3, 4 times a day, generally, check my voicemail at Rutgers if I'm not physically here. So if you reach out to me by email, I, again, try to be responsive. I'm not perfect, but I aim high. Telephone call. I'm at 973-3, you could Google me and the number comes up, 973-353-1727. I'll repeat, 973-353, 2017-27. Again, leave a voicemail if I'm not there. I will do my darndest to get back to you. Just say your number twice, just so I make sure I hear it and I can get back to you. All right, so let me just describe in general from 60,000 feet up, the income taxation of trust and estates, that in contrast to, we know different entities. We know individuals are taxed on their income. We know corporations, still called C corporations, derived from subchapter C, they're taxed at the corporate level. They file 1120. Current corporate tax rate is a flat 21%. And they are not a conduit entity. In other words, distributions from a C corporation do not give rise to any deductions, right? And distributions, I should say conversely, if distributions are made from a corporation, the recipient, assuming the corporation has what's known as earnings and profits, the recipient will have taxable income in the form of dividends, right? Right. And then there are conduit entities, partnerships, and so-called S corporations, right? S corporations are under subchapter S, beginning in Code Section 1361. And by way of contrast, partnerships are under subchapter K of the code, beginning in Code Section 701. And they file tax returns. Partnership files Form 1065. S corporation files Form 1120S. But they don't pay tax, right? The shareholders or members or partners pay tax. So income passes through vis-a-vis a K1, losses pass through, right? Right to the owner of that interest in that entity, right? Drum roll, because when we talk about trusts and estates, they occupy this unique sphere where they have a foot in both worlds, because they will earn income, and depending on distributions, they will be subject to tax like a corporation. They file Form 1041. But unlike a corporate enterprise, depending on circumstances, they may get a deduction for distributions made. Okay? A deduction for distributions. So it's got this unique characteristic that differentiates it from other entities in the Internal Revenue Code. So it's kind of neat how they operate. And we are going to be looking, if you look, and I know it doesn't hurt to look at the index because it gives you an idea of where this course comes and goes. And I'm a big believer of let's see the forest before we get into the trees. Tonight we're going to look at Chapter 1, entities subject to income taxation under subchapter J. And this is not uncommon. When you study partnership tax, when you study corporate tax, one of the first things textbooks commonly do is identify the entity that's being taxed. Kind of interesting. So the first chapter is going to look at and try to identify what is a trust, what is an estate. Chapter 2, we're not going to complete tonight, but under Code Section 641B, it starts with the proposition that trusts and estates are taxed like individuals, except as otherwise provided. So we're going to try to make sure that you understand the general principle, how do I say this? This is not the fundamentals of income tax course. Hopefully most, if not all, have either taken that course or concurrently taking the course. So this is not a review session, but chapter 2 is just to say essentially those principles apply here. Okay, those principles that you picked up in your income tax course apply to trust and estates. So that's chapter 2. Just for the general proposition that trust and estates are taxed very similar to individual taxpayers. Chapter 3 is probably the most important chapter for our purposes. They're all important, but chapter 3 is pivotal. Why do I say it's pivotal? Chapter 3 is the meat and potatoes of subchapter J because it discusses this distribution deduction and how it applies in the context of what are called simple trust and complex trust. So chapter 3, we're going to spend a tremendous amount of time because we're going to try to figure out who is taxed, the trust, the estate, or the beneficiary, okay? It's a question of not, we know how much will be taxed. Let's say it's $100. The question is, of that $100, how is it split between and among the parties? All right? Then, chapter 4 deals with what's called the entity ignored. And in certain instances, the Internal Revenue Code has decided that the grantor of a trust has so much indicia of control over the trust, so much control, that the entity should be ignored. Let me repeat, that if you can, and we'll see anyone know the trust that immediately comes to mind that fits a grantor trust definition? One that most of you in this room are probably familiar with. The quintessential grantor trust, guys, is a revocable trust. A client comes into your office and wants to set up a revocable trust where they could revoke it at any point. Well, that's pretty damn close to, or tantamount to outright ownership, right? If you could revoke a trust at your whim and discretion, that means you can essentially control its assets. So if that trust generates income, who should be taxed on it? The individual. So the trust is ignored. Does anyone know a similar kind of entity which is ignored for tax purposes? Most of you are or do.
Single member LLC.
Yes, single member LLC. Yes, if I speak loudly.
I can say it loud.
But you guys can hear me anyway without trying to project my voice. All right, so single member LLC, right? Everyone agrees is ignored for tax purposes. So the entirety of chapter 4 discusses those entities which are ignored for tax purposes. Those trusts that are ignored for tax purposes. They're known. Over Labor Day weekend, you can use this. You're going to be learning about grantor trusts. Okay? Grantor trusts. And we'll spend a fair amount of time because you have to identify what are the indicia of having a grantor trust. And then, chapter 5 we're gonna skip because, truth be told, these things don't happen in the real world, guys. They truly don't. So I would get rid of them. Chapter 5 doesn't exist. I mean, I know what goes on out there. None of what is here goes on. So spending a week or two talking about what the material in chapter 5, not going to be worth your time or mine. Chapter 6 deals with something known as IRD under code section income with respect to decedent. What is the quintessential IRD? Most of you are familiar with it. Say again, Karen?
State.
Yeah, I think you got to drill down a bit. Everyone knows, I'm sure in this room, everyone knows the quintessential IRD taxable under code section 691. IRA money, right? When you take money out, sadly someone dies, and they name you as a primary beneficiary, and you draw out the money. Does that come to you tax-free? No. You pay tax on it. That's income with respect to the decedent. Code section 691. IRD money is exempted from code section 1014, right? If you recall, code section 1014, basis equal to fair market value. Code section 691, IRD money is not subject to that rule. John?
For IRAD money though, like that, if that was part of the state that was subject to the estate tax, do you get credit against that?
Yeah, the 691C, you get a deduction, not a credit. Okay? You get a deduction for the estate tax attributable to that income, which we'll talk about. Code section 691C. In my opinion, when we get towards, I'm hoping, when we get towards chapter 6, I'm going to distribute my chapter 6 because I think it will be, there's a lot of cases that this book presents, and the textbook I'm trying to put together on this material is supposed to be less case-oriented, more practical information. So I'm going to try, assuming everything falls into place, get you a copy of chapter 6. You guys can be my guinea pigs, see if it works for you. And then we're going to add, because another thing that is going to be, in my opinion, if you're going to practice tax in the area of trust and estates, what's another facet that's not, we haven't mentioned tonight, that comes up in practice a fair amount?
Gifts?
Gifts always come up, that's ubiquitous, but, and I'm going to talk about estate tax. But one thing that I thought was wrong with this, not wrong with it, well, I thought in lieu of chapter 5 in this current textbook, there should be a chapter on charitable trusts. Charitable remainder trust, charitable lead trust, because when you practice, there's a lot of so-called split interest trust. And that's not here. And once again, I'm going to try to distribute the chapter from the textbook I'm working on in the area of charitable trust so that you guys can get a complete orientation. So that if we cover in our textbook the first 4 chapters, that will cover probably the first 7, 8, 9 weeks of the class. But then I will distribute, hopefully, at least 2 other chapters pertaining to charitable trusts and IRD, 2 important areas in this sphere of the world. Any questions? That gives you a sort of very, very broad overview of our mission for the next few months. Any questions? You're good? Everyone's good?
will be tested on the final exam? Will it be cumulative?
Yes. Shaniqua, practice. Did I do that all right? I had to write it out. But I keep looking at it, trying to. I'll blow it by next week, I'm sure. Any other questions? If not, I can start with chapter 1. I feel like we're back in kindergarten where I can say, did anyone do anything interesting this summer before I begin? Just 5-minute, 2-minute break here. Anyone want to report anything that they've done? I did see the movie, Crazy Rich Asians. Fun movie. Anyone see that? No one saw it? You guys, half the country saw it, but no one in my class saw it? Really?
150 million views?
What was that?
150 million views already?
150 million? Hold on.
Because you said half the country.
I don't know how many people. A lot of people. I think it was the #1 box office hit 2 weeks and last week, and the percentage drop was very small between the 2 weeks. So, anyone do anything else?
I saw Shakira 2 weeks ago.
Where did you see
She's
Shakira?
awesome in the Madison Square Garden. But by herself, she had like 4 people playing with her, and all the dancing she did by herself and singing.
She's a very talented individual.
Very talented.
Did she? I'm assuming she sold out her show, right?
She was supposed to perform in January, but she had throat issues, so it was full. It was full, yes. Before the concert, there were no more tickets.
Gotcha. Anyone see anything? Anyone else, or do anything else, or go to exotic countries, or anything like that? No one? Aaron?
Well, nothing exotic, but I went to Charleston, South Carolina, but to the beach part to see the loggerhead turtles being hatched. I only saw a nest. I didn't actually see any baby turtles being hatched. Apparently, they say they're by design, it's like hatched at like 3 or 4 in the morning, with cooler temperature ever. Just this way they hatch during like the night, and the birds don't eat them right away. So yeah, it was all for kind of nothing. But Charleston actually is a really fun city, little city to.
But did you see them born and hatched and going down the beach?
No, that's what I'm saying. You really have to literally be walking the beach, like from basically like 3 to 5 in the morning, and trying to. I was just
But I picture
there.
you doing that.
Huh? Well, where we were staying, here's like the city, like which is on the water, but then there's all these barrier islands, and you don't realize it's like a 25, 30 minute, 30 and sometimes even 40-minute drive to get to the actual beach side where they come up. So sometimes you either see them coming up to lay the eggs. Sometimes the guy was telling me, oh my God, it was just absolutely enormous, like 2,000 pound. Like they actually had to help her get back into the water. Just 2 weeks before I missed that, coming up to lay the eggs, and then but no, I didn't get to see anything basically.
All right, next time. Anyone else? Anyone else aside from turtles? Me? Nothing?
No, I sent my son off to college.
Okay. That's always a big event in people's lives. No one else? I was up in P-Town. Does anyone know where P-Town is? And I wouldn't have known that it's referred to as P-Town. My son was raising money for cancer research as part of what's called the, I think it's called the Penn Mass Challenge, which is a bike where they bike ride 200 miles up in Massachusetts. And at the end of Cape Cod is Provincetown. And it's known as, when I'm there, I learned that they all refer to Provincetown as P-Town. Has anyone else been to P-Town before? All right, it's a colorful place, let's put it that way. So that was my fun and games. All right, you guys ready? Talk about chapter 1. So let me just make some general observations that some are in the book, some aren't. And just again, I'm going to try to bring some of my experience to the table so that I can make some of this stuff come off the pages, because some of it may appear a little flat. So let me emphasize some things that you might not otherwise see in the textbook. all right? And you know, I've been doing this long enough where there's a cliche, a fish doesn't know it's in water. So my point in saying that is, as I'm rambling on here about what I think is pretty clear, you may not see it that way, so don't be bashful. We're not 100 people here. So just stop me if I'm losing you, because to me this is familiar. To you, to all of you, it sounds like this is new and unfamiliar territory, but I'm going to try to put myself in your shoes and try to convey the information in that fashion. All right, so we're talking tonight and the rest of the semester about trust and estates. And I said to you, the first chapter is dealing with identification. What is an estate? What is a trust? And the first thing we're going to learn is what is an estate. Now, it seems pretty obvious what is an estate, but maybe not to all people. And I just want to call to your attention a few things. Someone dies, guess what? There's an estate, right? And because no one fell off his or her chair, I think most of you knew that before you came tonight, right? And I just want to make sure that everyone understands the difference between probate and non-probate assets, because we'll see periodic references to probate and non-probate. Anyone want to tell the class what is probate versus non-probate?
I can try.
Go ahead.
I think that non-probate are those that are distributed directly to beneficiary, and probate are those that have to go through the court.
Okay, so give me some examples of non-probate.
401k, I think, is non-probate.
Okay, non-probate retirement assets. John?
Life insurance?
Life insurance. Anything else?
The house?
Death accounts?
Jointly held assets. Three things. We have retirement accounts. There's a beneficiary designation form, right? So if you leave your retirement accounts, the primary beneficiary, you say to your girlfriend, but your will says to your spouse, your wife, which one controls? The beneficiary designation form or your will?
Designation.
The beneficiary designation. Okay, everyone get it? I've seen a lot of malpractice suits where someone says, don't worry about the beneficiary designation form, we'll just put it in the will. The will is no place to designate where retirement assets go. Got me?
What about transfer on death, like taxable?
That is non-probate because that is automatic. It's like jointly held property. So life insurance proceeds go by way of a beneficiary designation form. You might name your spouse, you might name your children. If you name your estate, and sometimes I recommend for a lot of different reasons, the estate be named, then it becomes a probate asset. Because if you say, pay my $1 million worth of life insurance proceeds to my estate, it gets paid to the estate. Say again, Jessica?
It could be either.
I don't know what you mean by either.
Well, you're saying if the life insurance proceeds were supposed to just go to the estate, that would be probate.
You can make it. In other words, I could die and leave it all to you, Jessica. It's non-probate. But I can leave it to my estate, and whomever are the beneficiaries of my estate would get those assets, right?
If only a portion of the proceeds are.
You can do both. I can say half my proceeds to my estate, half to John.
But the half that's going to me is not subject.
It's not probate.
Oh,
Okay.
It like kind of contaminated the whole.
I don't know if I want to. Probate in New Jersey. Probate assets are assets in your own name, and they go by way of your will. What does that mean, probate? Does anyone know? What does the word probate mean? Has anyone probated a parent's will, grandparent's will in New Jersey? Your ex-husband. Sadly, he dies, right?
Yeah.
Okay. So what did you do?
Well, we had to go through the court, and courts
You bring the original will, a death certificate, and a check for about $100, right? How long does the process take?
It took long because, first of all, he didn't have a will.
Well, he died intestate without a will. But let me take an easier example. Anyone go to the probate court with a will? No. If you go with a will, guys, it takes 15 minutes and it costs about $100 in New Jersey. It's a very easy process. And what happens is if Alicia's ex-husband died with a will, she would have gone down to the probate court. And when you die with a will, it's called testate. You'll see that word used throughout the textbook. If you die without a will, it's called intestate. So you got to get some of the lingo down, guys, because by the end of the semester, I want you to talk the talk and walk the walk. Okay? So you go down to the probate court, you submit the will, death certificate, and it's a check for about $100. You fill out a questionnaire to qualify you as executrix. If you die with a will, testate, you're named as executor or executrix if you're a woman, executor if you're a man. If you die without a will, like Alicia's ex-husband did, he dies intestate, you're named as an administrator, okay? You're named as the administrator of the estate, right? And if you die without a will, often the judge will require that you post a bond, right, Alicia? So you have to, but if you die with a will, most wills say that you waive any requirement for a bond. But if you go probate a will, you fill out the questionnaire, you submit what I just told you, you will get issued what are called letters testamentary. Letters testamentary enable, if Alicia dies tomorrow, and I probate her will and she named me as executor, if I get those letters testamentary, I can go to Alicia's bank account and take the money out and put it in the estate account. It's a probate asset. It's controlled by the estate. If Alicia died without a will, I can petition the court to be an administrator of her estate. I'd be issued not letters testamentary, I'd be issued letters of administration. I could go to her Chase bank account the next day, withdraw the money, put it in the estate account.
How do you know how to Chase bank account?
Do you? I have no clue, but. All right. Art, you got that? It looked like you had a quizzical look on your.
Oh, no, I got it.
You got it? Probate versus non-probate. Again, let me summarize. Non-probate. Life insurance, retirement accounts, jointly held property. V dies, V's married. She holds her house jointly with her husband. She dies, her husband automatically gets title. It's not part of the estate. Everyone got that? If you own property jointly, whether it be with a spouse or a child with rights of survivorship, it goes automatically to the survivor. It's not part of the estate. John?
What if it's tenants in common?
Then it is part of the estate because it doesn't go automatically.
Is it half part of the estate?
It depends on the verbiage of how the deed reads.
Oh, really?
Really?
I have a question. I've heard that if I'm married, then even if I put on my 401 account, if I put, for example, my son as beneficiary,
You can't.
it has to go to my husband.
Yes.
Okay,
Unless he waives.
Okay.
Is that's only, it depends on which state you're in, though, right?
No, it's federal.
So all retirement savings?
No, IRAs, you don't, but other types of retirement accounts, the spouse has the right, because again, Congress is out there to protect surviving spouses. So unless, in most prenuptial agreements, you get the couple to waive their right to the retirement accounts.
Only 401k, but not IRAs.
Not IRA. Karen?
But if you are divorced, then you have the right to give it to your son?
Say again,
Let's
Val?
say, then if, which you were talking about surviving spouse getting the money or whatever it is, but if you are divorced,
If you're divorced,
Then
then
if
he
you-
or she has no rights.
oh,
Done.
There's no spouse.
There's no spouse. got rid of him or her parent.
I'm just curious, when you said jointly held property, like if you got married to somebody that already had a house, do they have to put your name on the house?
No, not at all.
Or no? I mean, it wouldn't be.
No,
wouldn't
so
be
Karen, you
necessary?
get married to a guy who, has the name in his name,
Yeah, already has a house.
and he has a house and he bequeaths it to his child of his first marriage. You're out of the house.
Oh, okay, so you do have to put your name on the house, like you have to
What-
add it.
Depends, I mean, if you want to be in the house or out of the house, Karen.
Okay. Okay, then it's not automatic, that's all I was trying to get, okay.
It is not automatic, don't, it's in, the check's in the mail too. John?
So, I know you said for 401ks automatically goes to spouse, what about like the other than regular IRAs, do you have like a SAP or simple 403B?
I don't know those for sure, I don't wanna say or venturing outside my comfort zone.
So should we, I mean, I'm just thinking about my own IRA, should I fill out a beneficiary
You
designation?
should,
I don't
every
think-
one of you
I don't
has,
think you can open up an
Yeah, they can
IRA
take you
without,
at that time.
you
Oh, you
have to have
can?
beneficiary.
Yeah.
Oh, I don't even remember, I did it so long ago.
check out, I mean, when I do people's estate plans, one of the first questions I ask, you know, what does your beneficiary designation form say? I just had a weird case, someone was very angry. Why was he so angry? Because he got divorced from his wife, and I think you know where this may be going, and his ex-wife, unfortunately, very sad, cancer, and it's a longer story, but the bottom line is she named him as the primary beneficiary on her life insurance. Or I should better say kept him as the primary beneficiary. Well, what does the law in New Jersey say? She died about 3 weeks ago, and he goes to collect the money, and what does the laws of New Jersey say, Alicia?
If it's more than 2 million, you have to pay inheritance tax.
Forget about inheritance tax for the moment. Here's the issue. Because, by the way, life insurance is not subject to inheritance tax.
It's not.
No, life insurance is not. New Jersey has the dimwit rule, which is many people get divorced, and what do they not do? They don't change their beneficiary designation. They mean to, but they don't get around to it. And then, you know, last I checked, everyone's mortal, and sometimes they die, and they don't change their beneficiary designation form where the ex-spouse is on. So New Jersey has a law that your ex-spouse is deemed automatically to have predeceased you, right? Which makes sense, because how many people leave money to their ex-spouse, present company excluded? I mean, most people do not want to leave a single penny or a nickel to their ex, right? So, having said that, New Jersey has, and many states have this prophylactic law that if you get divorced, your spouse is automatically deemed to have predeceased you, your former spouse, except if you have a beneficiary that postdates the time of divorce. Because there are some couples who reconcile, they don't get remarried, but you actually have to change your beneficiary designation form. Well, that wasn't done. So the guy calls me up and he is bitter because even though his wife left him as the beneficiary, it will go to the contingent beneficiary. So he's not a happy camper. John?
Does that happen at the time of divorce or the time of death that they're ruled to predecease? I'm like thinking.
It only matters at the time of death.
Right, but so say they move out of state after the divorce.
Again, I don't know because they didn't get into conflict of laws issues. So let's just talk about this couple was in New Jersey. And you can see the logic behind the law.
Do you know what would happen if there would be no contingency beneficiary?
And it defaults typically to the ones in state.
Estate.
Right? All right. So probate and non-probate, everyone get? Because when we talk about people's estates, generally those assets that go by way of beneficiary designation form are not part of the person's estate. Agreed? So even if someone is worth $10 million, you there may only be $4 million of probate assets, right? 6 million may be retirement assets. I see that commonly with physicians. They have $10 million, 8 million is retirement, 2 million is liquid. How long can an estate stay open? Depending on whether or not it's, I'll call it a friendly estate, whether or not there's, where the family members get along. Is there an estate tax return due? And we'll talk more about the estate tax maybe next class. I know there's some people not here today. I don't know if we need to indulge tonight in that. But I will. I'm going to give you a brief overview of the nation's transfer tax system, I promise. But there's a whole bunch of factors that go into how long an estate will stay open. Most estates that are worth real dollars stay open for a year or 2 or 3. That's my experience, right? Because the executor or the administrator, what's the first job of an executor or administrator? To what? Preserve, protect, marshal. That's to gather the assets. Next, and pay all debts, right? If you're an executor or administrator, you have to pay all the debts or their potential liability exposure, right? You're financially responsible for making it happen. So you preserve the assets, you pay the debts, including any taxes, and then you make distributions in accordance with the terms of the operative document. Assuming there's no litigation, again, my experience is anywhere from a year to 2. And it's not like the assets are sitting fallow. Hopefully the assets are invested. Now, I always say to executors who are not family members, what would you do? Some of you in your career may be named as executor, right? What would you invest in? Anyone want to tell me what you might invest in?
It depends.
Ron?
Municipal bonds?
Municipal bonds.
It depends how long the money is.
Let's put it this way. It ain't going to be too long. Your time frame is short, right? So my message to you is if you're an executor and it's not family, yeah, CDs, municipal bonds. Municipal bonds, you got to be careful, John. If interest rates shoot up,
Well, short dated.
you got to be real careful, right? I would not stay in stocks, personally, liquidated, because if the market plummets for whatever reason, they're going to blame you, because what are stocks really geared for? Long-term investors. Everyone agree?
What about treasury bills?
What about what?
Treasury bills.
Treasury bills. Again, on good days I know something about tax laws. I don't want to pretend I'm the quintessential investor here. I'm not a financial planner, okay? So my point though is this short-term horizon. All right? What about a trust? So everyone knows what an estate is. Everyone get a picture of what the length of an estate. If you have questions, let me know. But everyone can properly identify an estate, probate, non-probate assets, and the like. Okay? What is a trust? The code does not define what a trust is, okay? Just understand the code defines who is a fiduciary. That's defined in Code Section 7701A6. It includes executors and administrators and personal representatives and trustees. Those are fiduciaries. And by the way, if you could, I suggested, if you could get, if you haven't already, this one is gonna cost you more, and I would probably recommend you get the 2019 edition, even though the 2018 edition is cheap, because the 2019 edition includes the most recent Tax Act. All right, will you survive with the 2018? You will, but periodically, I'm gonna encourage you to Google it, particular code sections that have been changed. So just, if you can, get the 2019. Which one do you have, Karen?
I just copied and pasted into Amazon what you put on the thing, and it came up with 2018. I didn't even know the 2019 was available.
It just came
I
out.
ordered it.
I ordered it too.
Yeah,
Starting
it
at
is.
12.
It should be coming by September. Yeah, 12th or 11th, something
Oh,
like
maybe
that.
that's why it wasn't. 'cause it's such a
Actually, I
draft.
ordered it before, and the wrong one came, 2018 one came, and I said, send it back.
All right. I mean, Karen, don't. If you had the 2018.
No, I knew a lot of the other stuff for the international tax also wasn't in this one, so I was like, oh, I'd rather.
All right, well, I don't know what to tell you, but just be forewarned that this area has not changed massively, but there's a few things that have changed. You will survive, even if you had the 2018 version. All right. So, let's just talk about the fact that, again, Code Section 641, I already said to you, if you look at 641B, it says the taxable income of an estate or trust shall be computed in the same manner as that as an individual, except as otherwise provided as part. And it points out the tax shall be computed on such taxable income and should be paid by the fiduciary. Who is the fiduciary? Fiduciary, again, comes in the form of an executor, administrator, trustee. And what is a fiduciary? Just keep in mind, fiduciary comes from the Latin term fidel, F-I-D-E-L. Anyone know what fidel means in Latin?
Trust. Like loyalty.
Loyalty, right? Some people have named their pets Fidel, right? Someone who's loyal, right? So you're supposed to pick someone who's trustworthy as your fiduciary. Okay? All right, so you can see we're going to tax trust and estates like individuals except as otherwise provided. Who's responsible? The fiduciary. And how do we know what is a trust? And generally, for there to be a trust, there must be an intention on the part of someone to create a trust, and this is all under state law, not federal law. Let me emphasize that. The state of New Jersey and all 50 states have different laws about what constitutes a trust, but there are, I'll call them universal attributes of what you will find in a trust, including the fact that trusts are created with an intention to conserve and preserve property. There's a trustee named who is put in charge to conserve and preserve the property. And there are beneficiaries who are supposed to be recipients of the trust. Does it need, and bear in mind throughout the course, we're going to primarily be looking at two kinds of trusts. And again, I'm helping you out with your language. Language is important here. Inter vivos trust and testamentary trust. Inter vivos trusts are those trusts that are what?
That are like made in while the person's still living.
Right, inter vivos, during the person's life, right, Javier? And testamentary? At death. So sometimes I create trusts, and at the top it says trust. Those are inter vivos trusts. The person is alive. Sometimes I create testamentary trusts. And no, I don't hold a seance and have them sign it after they're dead. They're testamentary trusts because they sign their wills. And under the terms of their wills, they say, I hereby give, devise, bequeath the sum of $1 million to my trustees to be held by them pursuant to the following terms and conditions. And it sets those forth, right? So they're testamentary in nature. Everyone get the visual? It's a last will and testament that the terms of the trust are embedded in that document.
Does this happen sometimes when you have kids and they can't get anything until they're like 18?
Exactly. I set up trusts for children, and I say, as the single person upon Carlo's demise, he writes, I give, devise, my bequeath my estate in 3 equal shares for my children to be held in trust until they reach ages 30, 35, and 40 in 3 different caches. 1/3 at 30, 1/2 of the balance at 35, and then the remainder at age 40. Very common. The point the authors want to make here is that it doesn't need to say the word trust at the top for it to be taxable as a trust. Testamentary trusts, again, are routine. They're not always, they don't say the word trust at the top.
So if the person doesn't have a will, they wouldn't be able to do this then?
Wouldn't be able to do what?
The inter-testamentary trust. You said you
They could, and I'm here. I'll give you a good example. People set up revocable trusts. And when they die, what happens to a revocable trust, guys? It becomes irrevocable, right? Because you're not allowed to change it anymore, right? And many revocable trusts, Carlo, you could set up for yourself and say that when I die, I leave my assets of my revocable trust to my 3 children. So it can happen through a will, it can happen through a trust. So an inter vivos trust can become a testamentary trust. All you have to do is die, Carlo. Okay?
And have money.
And have money. All right? So we have a revenue ruling beginning on page 3. Revenue ruling 68-47. And some of these fact patterns are not always easy to read, guys. Here, in this revenue ruling, we have a single premium life insurance policy where you pay one amount up front, let's say $100,000, and the insurance company is supposed to hold that money and ultimately pay it out at your death and pay a fixed rate of interest to your beneficiaries. And then ultimately, upon the death of your beneficiaries, it gets paid to their heirs. All right, let me repeat this, because this is not easy to find. You have an insurance company makes an arrangement where you put in money, and the money is not segregated, okay? It's not like, usually when you set up a trust and you put in money, the trustee secures what? An employer identification number, right? They submit a form SS4, and they get an employer identification number, they open up the bank account, they put the $1 million into trust, and you're off to the races. Agreed? But here, you're giving money to the insurance company. Are they keeping the money separate and apart? There's 1,000 people. Are they each putting in their money? And is the insurance company setting up 1,000 separate accounts when you read this revenue ruling? The answer is no, right? What the insurance company is doing is holding this money and essentially saying, upon your demise, it's going to pay out X dollars to your beneficiary. Everyone agree? And there's an interest rate component. And the question is, under state law, would this be a trust? And should the insurance company start filing 1041s? And what does this revenue ruling hold?
That a trust wasn't created.
Yeah, that there was no trust created here. That this lacked the indicia of being a trust. Okay?
Because of the segregation component.
There is no segregation, right? But there's no escaping tax here because, bear in mind, that's always one way to consider, and we'll see this in a moment. Right? Is there any leakage here to the code? Because we know, everyone knows here, that Code Section 101, that are the receipt of life insurance proceeds taxable? No, Code Section 101A, someone dies and you get $1 million of life insurance proceeds, there is no income tax, right? What's my authority? Code Section 101A, agreed? However, the interest component is taxable, right? So if $1 million is paid, but now there's a 5% return or $50,000 a year, the interest is subject to income tax, right? Just Code Section 61. So, insofar as this ruling is concerned, the interest component would be subject to tax. So, this is not the most important revenue ruling you'll ever come across. It just talks about this kind of arrangement. It does not have your traditional trustee, beneficiaries, terms of a trust. Not going to be taxable as a trust, okay? No big deal. And that just sets the framework for looking at other arrangements. Some of you, for your children, have set up UPMA accounts, right? Uniform transfers to minor accounts. John, you probably deal with this here, right?
Yeah.
What, just for everyone's purposes, what is an UPMA account?
Just a way of essentially giving money to your children, but you manage it for them. In the meantime, they can't access it until the age listed on trust. In New York, it's usually 18, in New Jersey, it's usually 21.
Right, usually 21. So people set up UPMA accounts all the time. It's like the poor man's way of, I'm saying, but maybe it's a misnomer. Poor man's way of setting up a trust, right? Because you can manage the money, you don't have to pay lawyers to set it up, and people like John are happy to have your money, right, John?
Correct.
All right? And the custodian over the account manages it, child turns 21, and I say the poor man's way of setting up a trust because I have often gotten phone calls when the stock market was really going crazy, it was going high, people got unnerved because their children were going to be multimillionaires at age 21, and maybe son Joseph was not the most, how do we say, well versed with money, had a bad drug habit, you know, all sorts of bad things. And I would get the call, what can we do to stop Johnny from getting the money, right? And if you ever are having trouble sleeping at night, you can read this article I wrote about what to do. It's in the Journal of Taxation back in the year 2001, I think. And I wanted to name the article, at the time there was a TV show, it was very popular, Who Wants to Be a Millionaire?
Yep.
And I wanted my article to read, Who Doesn't Want Their Child to Be a Millionaire? I thought that was a catchy title, but the editors thought otherwise. So it has a much blander title. But if you're interested, John, for your clients, it talks about when your child becomes 21, having the UPMA account invest in limited partnership interests right at age 20, 20 or 21, right before it ends. And when the child becomes 21, give them interest in a limited partnership that is totally illiquid. All right?
So a minor is under 21, not 18?
For UPMA, it's defined under the statute, under the UPMA, New Jersey UPMA statute, and most banks will say 21.
Yeah, it depends on the state that you set it under. But
Right.
Could child come back and sue you as the trustee to say that's kind of, against their best interest?
Yes, they could, when we weren't in the article, they could, but that could take a few years to resolve, hopefully they'll, grow up in the meantime. So, you put blockades up and then you keep your fingers crossed, like they won't have the mental energy to engage in a lawsuit where they sue their own parents, but we warn them that that might not work. All right, the question is, Karen.
I'm just confused. Who exactly can be a trustee then? I see anyone being an executor, your family probably, or a good friend, and that's just a limited thing. But you're saying you set up this trust that could be for years and years, somebody who's investing it, like who do you
Right.
go to do that? I don't understand.
A few different reactions. And people commonly say, who should they name as trustee? Who should they name as the executor of their estate? And I would say it depends on your bench. What do we mean by that? Do you have siblings you can trust? How old are your kids? They could be candidates. And in other instances, maybe you want a professional, but they're going to charge.
So who's a professional? Yeah, that's what I'm thinking. I wouldn't know
John,
exactly.
you
what
probably
to do.
know professionals.
Like what kind of firm would you go to? Be like, all right, say maybe.
Merrill Lynch, U.S.
That's-
Trust Company.
Oh,
all
so,
that.
okay.
And you
really.
can open a trust account with whether it's just a simple checking account kind of deal or an investment account, you can do what you want.
Okay, just order the Charles Schwab and then have
Yeah.
a managed account.
Yeah,
Somebody can
exactly.
make it-
You
Oh,
can have
okay.
it, whatever you want.
I keep wondering, like, you just randomly designate somebody a trustee, and if they don't have any idea what to do with the money, they're like, well, what do I invest it in? They know that kind of.
I mean, you'd be foolish if you say, gee, I don't know what I'm doing, I'll just serve, because then you have a risk of being surcharged.
So a lot of places will offer a trust company in the sense that it's one, person group of people that work for said company as a separate entity that become the trustee of the account. They're professionals at that.
Oh, okay, that's what I was
They do
hoping,
that.
something like that.
But
Okay.
most times people name someone that they know. Yeah.
Right.
Okay.
All right, so, all right. So, the question the authors ask or attempt to ask, are these UPMA accounts trusts? Because they have a little bit of aroma of being a trust, right? Because there's someone managing the money, there's a child who's a beneficiary. They have an aroma, right, of being a trust, right? But they are not considered under state law to be a trust, okay? They are considered the child's money. The child, whatever that UPMA account earns, should be reported on the child's income tax return, right? So they are not considered a trust.
Have you seen at my account in trust or no?
You can't have an UPMA account in a trust. That's an oxymoron. They cannot be part of a trust. Okay? The authors mention something called a power in trust. Never saw it, never heard of it, not relevant. The authors do point out that children, as we know, are subject to the kiddie tax, Code Section 1G, and under the 2017 Act, there's a Code Section 1J4, Code Section 1J4 under the Tax Act, that kids are now taxed at what tax rates essentially? They're taxed at the same tax rates as trusts and estates, not their parents' rates, but trusts and estates rates. What tax rates are trusts and estates taxed under? What code section? Code Section 1E. You want to open it up? Do you guys have Code Section 1E? What is the highest tax rate? When does it kick in? By the way, notwithstanding that this is supposedly a new edition, ha ha ha, joke's on me.
No, wait. Do we have to return those now?
Low rate. I mean, I know and you know under Code Section 1E, what's the highest marginal tax rate? What?
37.
37. Unless you guys have, my 2019 edition has 39.6. Does anyone have 37 under Code Section 1E? I'll be jealous.
Should we return those or?
We can't return them, there's nothing newer. I'm just shocked that they don't have the latest tax rates. Everyone have that?
Mine says
There's also
396.
639 but this is Cornell, so they're not updated as well.
Cornell is usually updated. Anyway, guys, it doesn't matter. Code section 1E is the rate for trust and estates, and it's 37%.
It's not updated.
All right? Now, do we have any pet lovers out there? Any pet lovers? Someone's got it. Clitty, what do you have?
German Shepherd.
German Shepherd. Aaron, what do you have?
A dog, mixed breed.
A rescue dog?
Yeah, rescue dog.
Mixed breed.
Mixed breed, yeah, rescue.
V, what do you have?
2 Shih Tzus.
2 Shih Tzus? Okay. And V, if you set up a trust for your pets, is that valid in New Jersey?
From what I read, it wasn't. I was a little disappointed to read that
For your kids, you couldn't set them up? What are your Shih Tzus' names?
Cookie and Munchie.
Cookie and Munchie. And can you set up a trust in New Jersey, guys, for your pet? Good news is, you can now. You can sleep tonight, V. You can set up trust for your pets. Not all states have it, but New Jersey does. So welcome to the Garden State. You can set it up. Now there are some states that ignore it, that treat it as if it doesn't exist. So suppose you set up a trust for a pet, and let's go through 2 different patterns, because that's what this revenue ruling 76-486 does. It says, in the first scenario, what happens if the trust is void up front because the state doesn't recognize a pet trust? Then who pays tax? What this revenue ruling says is if the trust is void up front, and let's suppose B set up a trust for her 2 Shih Tzus for their life and then invested with her son, B's son. Well, essentially, B's son, if New Jersey didn't respect pet trust, B's son could immediately take the money and go to Atlantic City. So if the money earns income, he's supposed to report it, right? Because it's really his money. The trusts are only on paper, the state does not respect it. Conversely, suppose B puts in $50,000, the trust earns a 10% return or $5,000, and New Jersey respects the trust, and the trustee buys dog food or veterinarian care for $5,000. Who gets taxed on the $5,000? Not Moochie?
Munchie.
Munchie.
Oh,
Yeah.
Munchie doesn't file 1040?
probably not.
I don't think you're going to issue a K1 to Munchie.
K1 or K9?
No K9.
Okay, no.
That's a good one. I like that. No. So what ends up happening is the trust will not get a distribution deduction because Munchie is not considered a beneficiary. When you look at the definition of a beneficiary under the code, it must be an heir, not a hair, heir, legatee, or something along those lines. So there's no distribution deduction, so the trust would file a 1041 and report the $5,000 worth of income. Everyone got it? Her pets are not deemed beneficiaries. So there's no distribution deduction. If normally when a trust makes a distribution deduction, it gets when it makes a distribution, it gets a distribution deduction, but not so with a pet. Why does it get a distribution deduction? Normally the recipient has to pick up a corresponding amount of income. Everyone got that? Take a look. I mean, I'll leave it up to you guys that, you know, that a pet is not considered a beneficiary. In the material that follows, I wouldn't worry about number 2, perpetual trust. I wouldn't worry about 3, passive trust. Is the security deposit on page 8? Is that going to be considered a trust, guys?
Yeah.
You know, let me just make an observation that in most instances, security deposits, my experience, landlords don't pay or don't invest security deposits in any income producing asset, so it's kind of moot. They just hold the money in a non-interest bearing checking account, so my experience is this really doesn't come out. I wouldn't worry about the rest of this material because for exam purposes, I think everyone will know what is a trust, what is an estate. This is not going to be something, when I have clients come in, I don't scratch my chin generally and say, gee, first of all, we all know what an estate is. I don't scratch my chin and say, gee, is that a trust or not a trust? So yeah, the authors raised some esoteric issues here, but for exam purposes, don't sweat it. You're not going to be, this is not where I'm going to find fertile grounds to ask you questions. All right, so here's what I propose, guys. I thought there would be